Hi everyone, welcome back to FIN601. And after we've reviewed chapter 1 through 13, in here we actually can officially start our coverage in chapters in FIN601. And the first chapter we're going to introduce is chapter 14 regarding to distribution decisions. Remember, there are three main decisions making of a financial manager. Well, one important decision is capital structure decision that is related to the mix of debt and equity. And here, what we're going to introduce today is highly related to the capital structure decision. This is called distribution to shareholders. Okay, so firms can decide whether they want to keep their earnings or distribute the earnings out, a part of the earnings out to shareholders. And then the distribution can be in two forms. First, it can be in the form of dividends. Okay, we are very familiar with dividends. They are typically cash paid to shareholders, and they can be set as amount of dollar payout in form of dividends to each shares held by the shareholder. Okay, so the other form of distribution to shareholders is called repurchases. Okay, this is where firms will pay to the shareholders to purchase back the firm's shares. It's also called buybacks, buying back firm's own shares. It's opposite to public offering. Okay, we have initial public offerings where firms sell the shares to the public and then receive payment from the shareholders to fund the company's operations. Okay, so company with a public offering will give shares and receive funding or cash from shareholders. Okay, and companies with what we want to introduce today is repurchases. Repurchases. Company is giving shareholders cash and receives share back from shareholders. Okay, so that's what a repurchase is. And let me start with an example from Apple. A lot of the major investors and then financial analysts consider Apple as a buyback monster, since Apple has purchased more than 20% of their shares since 2012. Okay. It is expected to be on track to purchase another 30% within 3 years from now. At the end, starting at the end of 17, within 3 years of this time. Well, so let's look at Apple's amount of shares outstanding. Starting from 2003, Apple started to repurchase its shares, and therefore the number of shares outstanding is decreasing over time. What happens to the shares that Apple's buy back? They actually retired them from the pool of shares that Apple's issues. Okay, so up until now, it's about 20% reduction in shares. And what else is related to these transactions? Buybacks isn't the only way Apple has returned cash to investors. There's another form, which is the other form we mentioned, dividends. Apple has been giving dividends back to customers at regular intervals. Each quarter, Apple is giving back a certain amount of dividend to its shareholders. And of course, the share repurchases are also taking place at about the same time. You know, when Apple, in 2012, after the passing of Steve Jobs, the new CEO Tim Cook initiated paying dividends to stockholders. So this, in 2012, that's actually the first dividend being paid out by Apple over its life of the company. And then Apple's stock was around 100 in 2012, but it has quickly plunged to about half of its value in 2013. It was the time when billionaire investor called Carl Icahn, he purchased about 50 billion of Apple shares and then publicly urged Apple to buy back its common shares. Well, his reasoning is that Apple share has plunged for about half, and then it's an indicator that Apple share has been undervalued and will be beneficial for the Apple's shareholders if Apple spends its cash and buying back its shares to return its stock value to its original value. So, it's quickly, within a year, Apple shares has returned to the value prior to the dividend announcement. See, it doubled in 2014 and later on climbed up further. And many people attributed this rising share value as primary to the change in Apple's distribution policy. Okay. And another evidence from Apple's return of capital and cash position. So first 3 years, 12, 13, and 14 are in fiscal years. And then in more recent years, each of the entry is separated into 4 quarters of each fiscal year. And then this table also reports the buyback actions of Apple over time and the dividend payment from Apple over time. And combined both buybacks and dividends, and we get the total capital return to shareholders over time. Okay, let's see how much has Apple been paying back to its shareholders in terms of buybacks. Fiscal year 13 is the year where Apple initiated the repurchases, and then Apple gave back $23 billion to shareholders in the form of buying backs. And in 14, Apple has paid back, almost double what they paid back in 13, $45 billion in the form of share repurchases. And how about dividends? When Apple initiated dividend in 2012, it was a small amount of $2.5 billion. And in year 13 and 14, in both years, they are around $11 billion in the form of dividends. So dividends are actually much smaller than the buyback amount that Apple offered. And what about the years that are more recent? So we can look at 2015. The 4 quarters combined, it is about 12 plus 10 plus 14, 36 billion in the form of buybacks. And how much in dividend? Okay, so for 5, 6, and 6.1, that's about 11.7 billion for dividends. Okay, so the dividend amount looks like it's been very stable over time. About 3 billion for each quarter and about 12 billion each fiscal year. The buybacks, on the other hand, is not as stable. So, well, the amount is similar per year. It was 36 plus 15, and 13 plus 10 plus 6 is 29 for year 2016. And it is about 15, 22, 33 in the year of 17. So there are some variations, but not very large. Okay, and within each year, between quarters, you can see large variations. In the first 2 quarters of year 15 is small amount below 10, and in the later quarters, the last 2 quarters of 15, the amount is 10 and 14. So much larger than the first 2 quarters. And the trend is quite similar in 16. The first and second quarters is small, and the third quarter is a larger amount, and the fourth quarter it returns back to a smaller amount. In 17, the trend is not continuing. So in 17, actually the first quarter has the largest repurchases, and later 3 quarters are not so large. So the point here is that, well, the buybacks can be variable for each of the quarters, and it's up to the firm to decide. And the dividends are usually very sticky. As we said, they are following about the same amount for each of the quarters with small variations. Okay, and how does Apple fund its distribution in terms of buybacks and dividends? How do they do it? When you add up all the distributions, you can see the amount varies by a large amount over time. And then, well, Apple fund its repurchases in 2 ways. First, it started issuing debt, so collecting debt in 2013. Okay, and that's gonna make an effect in Apple's capital structure. Initially, before 2012, Apple had no debt, so it's funded by all equity. And after that, it's starting to add debt to its capital mix. All right, and next, Apple can fund its repurchase and dividends with cash collected from its operations. And then you can see the domestic operation has been stable, at least not growing. And the cash from international receipts are growing significantly. That is also why Apple has been able to keep going with, continue its repurchases and dividend payment to its shareholders. Now, you hear the news and then you may ask, why did that billionaire Carl Icahn push Apple to repurchase shares? What is the benefit for Apple? And we're here today to find answers to those questions. Okay, so today, here's our agenda. We are first going to introduce the distribution basics. Basically, shareholders owns the firm, and what do they get from the firm as a return? And we find appropriate way to pay out return to the shareholders is always a natural task for a firm's financial managers. Okay, so then the firm value, how does distribution affect firm value? We're going to also talk about the different implications of cash dividends and share repurchases. And last, we're going to find ways to determine the payout. We're going to focus on the residual distribution model, a basic model for determining the amount of distribution to shareholders. Okay, let's see what distribution policy is about. Well, firms collect cash flows. So first, company is going to generate sales revenue. And then from revenue, we deduct any operating costs and taxes. After that, we need to deduct the required investment in operating capital. Okay, so now what's left to us is our free cash flow. So it's up to the financial manager what he wants to do with the free cash flow. You can use the free cash flow in many different ways. First, he can pay out interest payments. Okay, and then he can pay out the principal repayment to debt holders. So the first two are to debt holders. And the next two, let me write it down, debt holders. And the next two options are to shareholders. First, well, a third among all of them is dividends. And the fourth are stock repurchases. Okay, free cash flow can be used to give distribution to shareholders. And the last one, it can be used to purchase short-term investments that can generate a short-term return for the firm to make sure the cash is not losing value just standing in a bank. Okay, so 4 ways to use the free cash flow from a financial manager. The case with Apple is that, well, the company has been performing really well recently, and it's had a whole lot of cash in its own account. Apple holds around $200 billion of cash, and it's still generating a lot of free cash flow each year at amount about $69 billion. Okay, so not long ago, Apple was debt-free. Like some other cash-rich tech companies such as Microsoft, it began to borrow just recently. Why do they start borrowing when they have a lot of money? And that's a question we're going to answer next week. Today, the message for us is that it has a lot of money to distribute to its shareholders. And how does Apple or another company are going to do with their distribution policy to shareholders? So the question first is, what do firms do with earnings or free cash flow? Yeah. So net income that firm generates eventually belongs to shareholders. But do shareholders receive cash payments out of net income completely? No. Well, firms can retain when they choose to. And what criteria does the financial manager has to follow to determine how much they want to retain? The retaining of net income is beneficial to shareholders only if reinvestment produces better return. What it means is the return on equity from reinvesting is better than a market return of the company's shares in the market, right? And the market return is called cost of equity. And the cost of equity is determined by the riskiness of its investment. And for here is the riskiness of the company's shares. Okay, so while the firms can make a decision how much they want to return based on how well they can reinvest the funds and to generate return for the shareholders, excess return for the shareholders. If there is a good investment project that its firm is seeking, they might end up retaining a lot of its retained earnings, a lot of its net incomes. And the rest of it, firm can decide whether to distribute it to shareholders. And they will first decide the level of distribution to shareholders, and then they will decide the form of the distribution to shareholders. They could be in dividend, cash distribution to all shareholders. Each of the shareholders will receive amount of dividend per share. Or they can return in the form of stock repurchases. These are cash distributions to some shareholders in exchange for their shares. So there are shareholders selling and buying every day in the market, and the firm purchases from those selling shareholders and retire the shares that's been in the transaction, and then gave the cash back to the shareholders who are selling. So, stock repurchases and dividends. Between the two forms of distributions, let's see how did their popularity change over time. So consider total payout as a percentage of net income has been stable at around 26% to 28% on average of U.S. companies. But within the two forms, dividend payout rates have fallen, and the stock repurchases has increased substantially over time. And repurchases now totals more dollars in distribution than dividends. So the big picture of all the firms in the United States is similarly reflected in Apple, since Apple has been paying more out in the form of repurchases than dividends. And there are still a small percentage of companies still pays dividend. And dividend payout has been more concentrated in a small number of large and mature firms, such as Apple. Right? And while young companies will not likely start with dividend when they first offer distributions, it's very likely the distribution will be offered in the form of repurchases. This trend has been carried over from the past. Think about those companies that are larger and older. They have been paying dividends for 10, 20 years, and there's no reason for them to stop paying dividends. But younger companies that started to be on the stage after repurchases has become more popular, and then there's no reason for them to start with dividend. And of course, the young companies has been I would say among the young companies, repurchases is much more popular than dividends. And we will explain why from a few introduction into the theories of dividends and repurchases. And next, let's look at the timeline of a dividend payment, and it shows us the procedure of dividend payment. So at first, on November 14th, 2015, the board of Katz Corp declared a quarterly dividend of $0.50 per share to the holders of record as of December 15. Okay, November 14 and December 15. Payments will be made on January 5th. The 3 dates are mentioned here. And what does each of the date mean? So initially, November 14th is called the declaration date, when the board announced all the other informations here. The dividend amount, the holder of a record date, and payment date, the other 2 dates. In December 13, which is 2 business days prior to the holder of record day, it is called ex-dividend date. This is the date when dividend leaves the stock price. Okay, any purchasers on or after this date will not get the dividends. Well, it's related. Well, why the 2 business days? It's related to how each of the transaction is reported to each of the company. So the company decides on who they purchase, who they pay their dividend based on their record of holders. Okay, so it takes 2 business days for the transaction to be reported back to the firm, and of course, so we deduct the holder of record date back to 2 business days, and that's when all of the transactions beyond that date, that was when all of the transactions will be reported back to the firm. So if you want the dividend for the shares, you need to purchase and hold the shares until December 12th. Okay. And December 15th, well, 2 days later, it is official the holder of record date. So if you purchase the share in December 12th, your transaction will be reported and recorded at the firm's book on December 15th. And this is the date used to determine the ex-dividend date and determine the holders that receives the dividends. January 5 is the payment date, which is when the dividend is actually going to be paid to shareholders of record. All right, so this is the whole procedure of dividend payment. Next, let's look at the procedure of repurchases. Well, initially, firm announces their intent to repurchase stocks. Then they have a choice of 3 ways to repurchase. Well, first, they could have broker or trustee purchase on open market over a period of time. Okay, so how this work is their broker is going to gradually purchase in an open market from any sellers in the market, just like you and me purchases on a stock exchange. This is how brokers purchase back the shares as well. And the next one, they can make a tender offer to shareholders. And how does tender offer work is that they are offering amount a certain stock price and then specify a date so the shareholders can decide whether they want to sell back to the company at this amount before that date. The company will collect their sale orders and then will, based on the number of shares tendered from the shareholders, the company can make a decision how they want to proceed as a tender offer. And last one, they can make a block or targeted repurchase from a large shareholder, from like a private investor, right? Just any large shareholder. And these can be private arrangements. Okay. Well, okay, what do company do with the shares they repurchased back? Oh, they could be retired. And once the shares are retired, it's been canceled. It no longer exists and cannot be sold by the company. So in the balance sheet, when shares are retired, it reduces the common shares account by the number of shares retired or purchased. Okay, And the next one, they can treat the shares purchased back as a treasury stock. And treasury stock is one entry in balance sheet, usually below common shares. And the shares, number of shares repurchased appears in the treasury stock as a negative entry. Negative shares repurchased. Okay, so these treasury stocks are held in the company and they can be used for future reissuance. So what can company use it for? It can be used for when they needed additional funding, or they can be used for employee stock options. When their employees decided to exercise their stock option, they will be getting the share of the stocks from the company, and the company will issue them will give the employee their stocks out of their treasury stock account. Okay. For example, Apple made such big repurchases, and the shares they repurchased were retired. Apple was not carrying any of the treasury stock account. All of the shares that Apple repurchased are retired and then eliminated or canceled out of their shares, a total amount of shares. Okay, so that we mentioned is the retired amount of shares reduces the common shares account on a balance sheet, and of course, in turn, it will change the mix of debt and equity. Okay. So this is usually a good way that company likes to adjust its capital structure. Yeah, repurchase is very useful in this for this purposes. Next, let's look at a numeric example to summarize what the procedure of dividend and repurchases, how does it affect the company itself. So the numeric example start with these given information. Okay, so the value of operations we started with $1,937.50. And the firm has put aside some short-term investment. Firms can keep them in short-term investment or to distribute it out as dividend or repurchases. And the firm has some debt, and then the number of shares is 100. And then, firm has decided, well, I want to return everything in the short-term investment to shareholders, either in dividends or repurchases. Okay, so before the distribution, let's look at the intrinsic value of the firm. Well, we copied the value from operations and we added the short-term investment to get the total value of the firm. And then we subtract that to get the total value of the firm's equity. And then with this, and we divide by the total number of shares to get the stock price per share. So the current intrinsic value of the firm is $16 per share. Now let's look at what happens after the firm pays dividend. While the value of operation doesn't change, but the short-term investment dropped. So the total value of the firm dropped by $50 billion as well. And the debt doesn't change, so the total value of equity dropped by the amount of the payout in the form of dividends, 50 billion. And the total number of shares doesn't change. So total value of equity divided by the number of shares also dropped. And per share value, the stock price per share value dropped by $0.5 each. And of course, the dividend per share is the total payout of 50 divided by number of shares, 100, that's 0.5. So the stock price dropped by the same amount of the dividend per share. In the real world, stock price drops on average about 90% of dividends. And that's due to the limits to arbitrage, just like transaction costs that doesn't allow the shareholders to fully deduct the share dividend distribution to the share price. So this was in theory what happens when firms pay dividend. And next, let's look at repurchases. The key about repurchases is that, wow, I just got a low battery warning and I plug in the cord, so we're good. The key about repurchases is that we need to find the number of shares repurchased. So assuming the firm is doing open market repurchase, so the number of shares repurchased is actually just the total shares, a total amount of cash available for distribution divided by the price of the stock prior to the repurchase, right? So when the firms decide to repurchase, they will have to buy at the market value before the repurchase actually happens. So this is how you determine the number of shares repurchased. And what happens to the shares? They leave the shares outstanding. So you're going to take the initial or shares outstanding, number of shares outstanding prior to repurchase, subtract the number of shares repurchased to get to the new or post number of shares outstanding. Okay, so in this case, we have 100 shares before, and then we purchased how many shares? We used $50, and the share value is $60 per share. So we repurchased 3.125 shares, assuming it's billions, and then we are okay with the fraction. So 100 less 3.125 gives us 96.875 number of shares outstanding after repurchases. Let's keep it in mind and then come back to our tables. Okay, so after repurchase, value of operation doesn't change, and then short-term investment dropped by 50. Okay, paid out as well as repurchase. I need to fix that. Let me change it right now. Paid out as repurchase. Okay. And then, so the total amount of value of the firm dropped by 50 as well. That doesn't change. What changed is the total value of equity dropped by $50. This is the same with dividend. And well, for dividend, the total number of shares doesn't change, or for equity, for repurchases, the total number of shares dropped by the amount of the repurchase, the number of shares repurchased. Okay, as we figured out in the previous slide. Now we use the value of equity divide by the number of shares outstanding post the repurchase. Well, the share price for the stock is actually 16 again. So the share price from repurchase doesn't change at all. It was 16 before the repurchase, and it's 16 again after the repurchase. So what's changed is the number of shares outstanding. Now let's summarize the difference between the dividends and repurchase after the distribution. So what has been the same between dividend and repurchase is that short-term investment falls, and they were used to pay either dividend or repurchase stocks, okay, by the same amount. And value of equity falls also by the same amount. Changing to panes. So short-term investment falls by the same amount. Value of equity fell by the same amount, and that's the amount equal to the distribution. Next, wealth of shareholders. That's not something listed in here, but consider the wealth of shareholders as part is the stock value they have in hand, and the other one is from the distribution. Okay, the cash received from the firm. So the total wealth of shareholders of the firm remains at the same amount. Okay, stock value, the total equity value dropped by the amount of the repurchase, $50, but the cash distribution received by all of the shareholders went up by 50. So that's why the wealth of shareholders remains the same. And firm value is unaffected between between dividends and repurchases. Okay, they're the same. But what are the differences? As we mentioned in the previous slides, for dividends, the price went down by how much? By the amount of dividend per share. And the number of shares outstanding doesn't change for dividends. How about for repurchases? It's the reverse, right? Stock price went down for dividend, but it remained the same for repurchases. And the number of shares outstanding remains the same for dividend, but it went down for repurchases. Okay. So this page summarizes the differences of dividends and repurchases. And the next slide shows us a nice graph that tracks stock price over time. And now it separates it into the repurchases and then dividends, the two cases. And we can compare how the stock price changed over time that are different between those two forms of distributions. Okay, looking at the stock price, assuming this is a firm that's performing with a constant growth. So with repurchases, the firm's stock price is going to grow as a constant rate. Okay, grows and appreciate at a constant rate. While with dividend, the case is different. So as dividend leaves the stock price on X dividend date. Okay, the stock price will drop by the amount of the dividend per share. So the stock price declines on ex-dividend days. And if you compare the accumulated outcome of repurchase and dividends, is that for repurchases, the stock price will stay stably growing at a constant rate, but for dividends, the stock price will be lower than if the firm only conducts repurchases. But another point I want to mention is that from the shareholder's point of view, do you prefer repurchases or dividends? If you care about the total value of return or total return. Actually, there is no difference. Remember in the previous slides, we said the total wealth of shareholders related to the firm doesn't differ between the two forms of distribution. Okay, stock price is only part of the return invested in this firm. Dividend is another part that should be added back to the stock returns. So once that's been done, we will bring the return of stock price, a return of shareholders from dividends to the level of repurchases. Okay, so the total return from capital gains out of repurchases plus the dividend yield will go back to the total return value, same as the repurchases. Now, let's look at the implication of the distribution on firm value. So, the distribution policy doesn't affect firm value. There's no influence on firm's cost of capital. How is cost of capital determined? It is determined by the firm's amount of risk. Okay, it's out of business risk and financial risk. Business risk doesn't change, and as long as the firm maintains a sound capital structure, the financial risk does not change either. So the cost of capital should not change regarding to a distribution policy. And next, the free cash flow will not change due to distribution policy either. So free cash flow is a result of operating and investing decisions. So the distribution is related to a financing decision, and it's not has a play in free cash flow. Okay. And next point here is theory has been developed by Miller and Modigliani. This is, I guess, the most important important theory that has been developed for modern corporate finance. This sets the cornerstone of modern corporate finance. That is called dividend irrelevance theory. So what it says is that investors don't care about payouts. The value of a firm to shareholders depends only on the income produced by its asset, not on how this income is split between dividends and retained earnings. The theory assumes that investors are indifferent between dividends and retention-generated capital gains. So when firm pays out its net income in the form of dividends, to the shareholders' point of view, these dividends are cash flows, and then they are taxed at ordinary income. And if the company, doesn't pay it out, but retains all its earnings and reinvests it in firm's operations, that's going to increase the firm's share price value. And that's going to be viewed as, from the shareholder's point of view, as capital gains. So when investors are indifferent between ordinary income and capital gains, then if they like cash, but the firm does not pay dividend, a shareholder can sell its stock and receive part of its stock and receive cash. So if a shareholder wants a 5% dividend, they can create it by selling 5% of his stock. And if a firm pays a higher dividend than the investor wants, investor can use the unwanted dividend to buy additional shares of the firm. And this way, shareholders can also adjust the dividend payout ratio by to the optimal amount that the investors want. Theory is very nice, and then it inspired a lot of follow-up research and set up the entire modern corporate finance. But theory, initially they're always making unrealistic assumptions. So in what's here is there's no taxes and there's no brokerage costs. In reality, firms still pay out dividends and firms still send out repurchases. And why do the firms still do that? And does the investor really indifference between dividends and capital gains? Actually, dividends and share repurchases have very different implications to shareholders. So first, shareholder could, when a dividend is announced, it could change the perception of shareholders for expected free cash flows. Okay, when dividend is announced, shareholder might consider the firm that is committed to paying regular dividend. And that could signal that the firm is anticipating more than regular free cash flows. And that's a positive signal to shareholders. And alternatively, if firms announce repurchases, and that's a different, that conveys a different message to the shareholders. Shareholders might think that the firm's management considers the firm's shares as undervalued, okay? Indicating undervaluation of the shares. And that's why firms would like to use its cash to purchase undervalued shares. So two sets of signals, and dividends and repurchases definitely send very different signals. And this next implications are implications on risk and tax. First, dividends are taxed as ordinary income, and capital gains are usually have favorable tax treatment with a lower tax rate. So that's gonna have a different, it gave investors very different incentives. And also risks. So dividends are usually carries higher risk since dividends are expected to be paid out regular. But repurchases in the form of capital gains are usually isolated, and the firm doesn't need to commit paying it out regularly. So dividend comes with higher risk for firms. And from investors' point of view, if firms are committed to dividends, maybe they have, they're anticipating less risk in the coming years. So let's stop here for the first part of this chapter's content, and then we'll come back to talk about the theories of distribution policy, including signals, including the risks from the shareholder's point of view and tax consideration as well.